Okay, so this is a chart. Credit to the Foundation for the Study of Cycles for the data on the chart. The one problem I think most of you recognize, realize, if you try to do a really long-term chart, is Excel thinks that nothing existed before 1900. So when you try to do a long-term chart prior to 1900, you can't get the dates done. I mean, there'd be a way to do it. You could actually, the numbers that I have on the bottom correspond to dates for me. So I know where they are. And the general guideline here is just look at the dates on the top of the screen right under the title. And they give you an idea generally where each of these things happen. So here's one thing that I noticed. I looked at this long-term chart, security prices, and two things stand out. There are two very obvious long-term tops that lead to the greatest declines on the chart. The first one is here in 1835, and it's a log chart. So as we all know, you can judge the magnitude of declines just by looking at the distance that they move. And obviously, the two greatest declines begin at this top here. That was September of 1835. And this top here, which was 1929. And so we can see those two declines were the greatest in the history of the security prices that we have, going back to 1789. So I looked at this chart and I said, okay, let's just do a very simple, simplistic cycle analysis. It won't be statistically significant, but let's just measure the distance from this very important high to this very important high. And it turns out to be 94 years. So again, simplistically and without statistical significance, you go forward 94 years from 1929, and lo and behold, you come to 2023. So if there's going to be a repeat of this very long-term pattern, September 1835, September of 1929. Actually, this was not September of 1835. The high here occurred, I have it written down somewhere. Let me see what date it was. It was May of 1835. The high here, according to the Foundation data, was May of 1835. This high was September of 29. So it was 94 years and 7 months. Okay. So what I did was I said, as we all know, those of us that track cycles, there are often half cycles or 1/3 cycles. I discovered in this particular cycle a 1/4 cycle that seemed to be working very, very nicely. And it comes out to, let's see, I wrote September 29, and 94 years and 4 months is the distance between these two highs. And if I divide that by 4, that comes out to 283 months. And 283 months comes down to 23 years and 7 months. If you break this cycle from here back to here into fourths. So 1/4 cycles would do that. So I said, all right, we broke into fourths. Let's take a look what that would call for from 1929 forward. Well, it turns out that September of 29 is here. The next resolution would occur in April of 53. Now, that's the only one that's not obvious here. April of 53 is right just above this little low that we see here in the 53, 54 time period. You could argue that that's picking out this low because from this low, which we never returned to again, we obviously had a fabulous move without any very significant declines until the 2000s. So that was the first resolution. The next resolution was November of 76, and that was a very good one. Here's November of 76 right here. And that was about a 6-year high. We really didn't surpass this November of 76 high convincingly until 6 years later. And as you all know, 6 years in the market is a long period of time. to not go to a new high. The next one, ideally, would have been June of 2000. And that's obviously in the year 2000, where we saw a group of market highs at varying time signatures, okay? The Dow Jones Industrial Average topped in January of 2000. The NDX, over the counter, topped in March of 2000. The New York Composite Index, all the stocks in the New York Exchange, did not top until September of 2000. So June's right in the middle of all of those. And the resolution ideally here would have been June of 2000. So this is great. What happened next in terms of my thoughts and analysis is fabulous. I really love this. I looked at this and I said, okay, it's reasonable to say there are some important resolutions at 23 years and 7 months that we see all along. From the 29 high, I should start here, with the red arrows that I have. There are reasonable resolutions of important, most of them market tops. One of them you could argue is a market bottom. But to me, the big test would be if I went back one resolution, at least one, and said, okay, where would this have resolved if we go back a resolution for 23 years and 7 months? And the answer was it would have resolved in January, February of 1906. Okay, now there's a little red arrow here that points to that general time zone, but I'm going to show you a chart that I would contend very few people have unless they constructed it manually. And this chart comes from a cycle book, an excellent cycle book written about 50 years ago, right around the time as the Hearst book was written. Is the guy's name going to escape me? No, here it is, William C. Garrett. I don't know how many of you have heard of him, Garrett. And the name of his book was Investing for Profit with Torque Analysis of Stock Market Cycles. Well, I recalled, because I have this book, and if I showed you the cover, it's so tattered and worn, it's hardly stayed together. But in the book, Garrett has a chart of the Dow Jones Industrial Average since inception on a monthly basis. And I realized that, and I got excited, and I said, I have the data, but the data doesn't really help you when you want to visualize it. So I said, let me go back and look at Garrett's book and see, theoretically, there should have been an important, generally there've been tops or maybe a bottom in January, February of 1906 to prove the consistency of the cycle. Well, watch this, everyone. This was very exciting. I'm going to go to, this is a camera copy of the chart. Can you all see where January, February of 06 was? Here it is right here. I looked at that. I said, wow, that's fabulous. This is the highest point on the chart. Now, the chart goes through 2015 on the right, which I don't think is visible to you. And in 2015, when they actually restructured some of the indices, I think the Dow Jones Industrial Average, they were all restructured. And at that time, it goes to a new high. But that was almost a decade later. So look at this high in Jan-Feb of 06, just where it was supposed to be on this 23-year and 7-month cycle. And that excited me very much. Mm-hmm. I saw this and I said, wow, that's fabulous. An exact resolution just where it should have happened. Now, in fact, I'm going to show you, I'm going to do a little, I have a cursor thing that goes north and south and east and west. And here's the high right here. And as you can see, even later on in 09, when we had a big rally, it did not get up to that 06 high. So it was a very important high that lasted for almost a decade. Okay. I wanted to show you that to see how that one had actually been pinpointed. Let me go back to the longer term chart.
Hey, Peter.
Yes.
Is there, you have those blue vertical dashed lines. Is there a significance to those on your chart?
On this chart here?
No, the one you were showing earlier.
Well, let me show that again then.
Yeah.
This one here.
Yes, sir.
The only significance to the blue dashed lines is because, as I said, I couldn't do dates at the bottom on Excel. They wouldn't recognize dates before 1900.
I
I
see.
wanted to spread
Okay.
these things somewhat equally apart and give a perception of where you were time-wise on the chart.
Got it.
Otherwise, you'd look at it without these lines and the headings at the top and say, where the heck is that? So with these lines, you can look at it and get a general idea
Okay. So
where each line is.
that's not a cycle that you're
No,
trying to
no, that's
point out to
the
us
only
there.
significance is a time identifier.
Great. Got it. Thanks.
So here's 1906 on the chart right here. And again, I went back, I continue to go back 23 years and 7 months. And the consistency, I think, was very impressive. Um, I'm not going to give you all these dates because I don't think I wrote them down. But if you want to examine, if any of you has the data from the foundation, you'll see that this was. I thought I had written these down, but I don't see where I have. But without giving you dates, let me just show you generally where they landed. The next one back was right here. You can see that lasted for this is several years here on the monthly chart. The next one was a low, and probably one of the most important lows in this whole time sequence. I think what you can see at the top here, it was close to 1859. So it was right in this time zone of a very important low. Going back again was the initial 1835. This says September. That's just a time identifier. The actual high came in May of 1835. And then back one more iteration. And this one didn't work out so great. It came in the middle of everything. But starting from 1835, the consistency of a 23-year, 7-month cycle, I won't call it astonishing, but it was pretty damn good. And especially this '06 hit right here, which I showed you on the monthly chart and was virtually perfect. So what this chart is telling me is that we have both the fractional 23-year and 7-month and the longer term complete cycle, which we can't really call a cycle yet because there's only one iteration of 94 years from May of 1835 to September of 1929. And that would take us, by the way, if you go out exactly that same number of years and months, 94 years and 4 months. Well, you add 4 months to September of 29, the 94 years takes you to 2023, and the 4 months takes you to October, November, December, January of 2024. Welcome to the ball game. So if there's any consistency, and again, statistically not significant at all, but the inner cycles appear to be quite significant. And they're giving that same information, 23 years and 7 months. And so you can argue, I get one of the ways you can try and pin it down and be more exact is just measure from the different highs that occurred in 2000 and go out for those 23 years and 7 months. And they would give you different resolutions. I think the furthest you can go out in 2000 for a high actually occurred in September. I think it was September 1st on the New York Stock Exchange, if I recall. So if you go out 4 months from September again, you come to January, and the 2023 changes to 2024. And so you end up with January of 2024. So that's the potential resolution here for these inner cycles of 4 iterations between the very major 1994-year tops. May, again, this says September, that's just a time identifier. May of 1835, September of 1929, January of 2024. Okay, that's part number 1. What did we want to show next?
Hey, Peter, can I show something briefly?
Sure, absolutely.
So I've been studying and looking into the work of Ray Tomes and his harmonic theory.
Okay.
And so this is a spreadsheet of all of the harmonic numbers. And this is the years column over here. One of our colleagues, Peter Slane, on this call put this sheet together. So
Okay.
these numbers are all mathematically generated. And 23.72 is one of the numbers, predicted by harmonics theory as
Interesting.
a significant number. And the basic idea of harmonics theory is that, you start with one wave and then it splits into two waves, and those two waves split into two more waves, and it's a count,
I love
basically.
it. I love it. I
And
love it.
where
Fits
are those kind of points of confluence where a lot of cycles come together?
very
And
interesting.
so it was
I
very
love that.
striking to me that 23.72, so that would be, about just short of 23 years and 8 months, so a little less
Yeah.
than.
Yeah. It fits in quite well.
And that was quite um, nice coincidence.
I love it. I love
All right,
it's
back to you.
my wife, who writes religious books,
Uh-huh.
instead of using the word coincidence, says God incident. So
Nice.
anyway,
I like it.
so let's let me show you this. How do I get back to my chart to be in
You
the
have to
front?
share your screen again.
Okay. Share screen. Oh, it said, well, the only choice I have is the your overlay in the Zoom meeting. And at the bottom right, it says leave. I don't think I want to do that. Oh, here we are. Okay, here's share screen. Share screen. Page. There we go. Okay, so we're just about done with this chart, but if I want to be in front of me when I discuss what I'm going to come up with next. It's not necessarily cyclically oriented, but I would argue that it is because of what it shows and what time periods it talks about. I don't know how many of you have heard of John Husman, but John does what I think is extraordinary work in terms of market valuation. He's been accused of being a perma bear. I understand that accusation because it's been hurled at me many times. The interesting thing is, when I started the business back in the very late 60s and 1970s, for about 15 or 20 years, going into the 1990s and 2000, I was accused of being a perma bull. What was very, very bullish back in the early 1980s and for quite a while after that. And I was called a perma bull. And from probably 2000 on, I've had a bearish bias. A lot of it had to do with valuation, but also longer term cycles. But when I saw Husman's work, I was struck by it, and I thought it was quite extraordinary. And he has a chart. I don't know how many of you have seen it, but I'm going to show it to you now. That is quite extraordinary, and I want to bring that up next. Let me go to that chart if I can get it. I think it's right here. Can everyone see that?
Yes, sir.
Okay, let me explain what this is. It's explained on the chart, so if you have a video and later on you can pause it and look at it. I don't know, again, how many of you have seen this, but this is fascinating. Husman equity risk premium model, projection of return in excess of treasury yields. I mean, he says two different things here, and which to me are a little confusing. This is the big headline at the bottom. He says projection in excess of treasury yield, but up above here within the chart, the first line says estimated 12-year S&P 500 nominal annual total return. Says nothing about in excess of treasury yield. So I don't know which one he's saying this is, but I know this is a very, very impressive chart. Let me quickly point out to you what we're looking at. The red line is the actual return over a 12-year period. And so it gets a little confusing on the chart because as you look at this chart, let me put my vertical cursor here. As you look at this, this is the last data point on the chart. Well, if you go down and look at the scale below, it's around 2012, 2013. Well, it's at that level right now because remember, he's looking at 12-year returns. So this was the actual return into the current day today, okay? The blue line represents where he estimates this red line will be 12 years from now. And the remarkable thing is that it has now gone, he's been ranting and raving now for well over a year or two, because we were down at these levels, down the lower end of the scale. And these levels were, here's at the 2000 top right here. This was the projected return right here. And you can see how very close it was, because now in real time, even though the red line is 12 years gap back, look how close. In fact, look at the whole chart and see how very close the red line ended up being to the predictive blue line, okay? It's a remarkable consistency of returns. Now, there are times, such as the current time right here, where the red line is well above the blue line. And his explanation is that the actual 12-year return, which he says right here, is unusually high when the end of that 12-year period happens to be a bubble peak. So obviously he's attempting to identify this red period here, which is well above the predicted blue return line, as a bubble peak. That also happened back in 2000. Notice vertically on my cursor, this is where the total return, actual return occurred that was predicted in 1988 to be down here. So in 88, the prediction was that the nominal return, annual return in the year 2000 would be right around this level, which looks like it's around a little over 6%, if you look at the scale on the left. And it actually was way up around 10, 11%, okay? But look at the consistency of how the red line follows the blue line. Now, here's the important thing, and this is what he talks about. I'll bring my mouse back without the vertical cursor. This is where we are as of February 9th of 84. And this predicted total return for the market based on, I'm not going to go into the explanation. If any of you want the total explanation of how he calculates this, you can go to Husman's website. All this information is given freely on his website. Husman, I think it's Husman Econometrics, or just Google Husman and his web page will come up. But this is the expected current return in February, on February 9th of 2024, okay? It is lower than the returns that were expected at the fabulous previous incredible bubble in 2000, which is right here. And in 1929, look at the blue line, which is right here. So they were one of the few times, let me bring the horizontal cursor again. And I'm going to put it at the zero level. The zero level is right, I don't know if you can see it, but move it back and forth right in here. This is the zero level. And there are very, very few times in history where it gets below the zero level. And this is where we are today. If you go across to the left, we are, conversely, when we see this as the predicted total return, whether it's in excess of treasury yields or whatever, you talk about an 8.5% return. I was going to do it just before we came online. I had done it in a spreadsheet, but I couldn't find it. Just compound at a minus 8.5%. I don't remember what the result is after 12 years, but it's in the minus 55, 60% category, 12 years. So in other words, from now to 12 years from now, minus 60%. Now, Husman is careful in insisting that these things do not attempt to do market time. He's not saying that, hey, look where we are, so we must be at the top. But he's saying that he's very confident that this red line 12 years from now will be somewhere in this territory. And as you can see in these prior predictions or projections of the line, remember, when this blue line occurred right here, if you go back 12 years, this is where the returns were. So the market was returning, was giving this kind of return in 1988 or so for a 12-year period. And the prediction at that time was 12 years from then, you'd be down at this level. And this is how far off he was. Maybe 1 or 2%, 2.5% the most. Same thing back in 29. Here's the blue line was the prediction in 29 from the data. And it was, looks like about minus 6%. And the actual went lower than that in this case. The red line, the actual return, exceeded minus 7.5%. So the reason,
Peter, just to be clear, so
sure,
what that's predicting is that over the next 12 years through 2036, that
correct.
treasuries will yield 8.5% more annually than stocks, than equities.
If you take this in excess of treasury yield, yes.
Yeah.
I mean,
Well,
that's,
that is what, and the red line says actual subsequent 12-year S&P 500 annual total return
right,
in excess of treasury bonds.
right. I mean, think about that. That's
Yeah,
remarkable.
it is.
Minus 8.5% annually compared to treasuries? What the hell does that mean? Now, if
Means
we
a
didn't
lot of
have,
pain for equities
if we didn't have over almost 100 years
and a
of
lot of
history,
gain for bonds.
yeah. If we didn't have, well, I mean, we don't necessarily know that because the bonds may go down too, although
Right.
unlikely, but on a relative basis, yes. This is how the equities underperform the treasury yields. Just remarkable. Now, here's the reason why this makes sense to me. The reason why it makes sense to me is that we just looked at those longer term cycles, that 94-year cycle. Those two tops in 1835 and 1929 led to the greatest market declines in history. And so if you work backwards, you can say, well, those must have been the two most overvalued points in market history based on subsequent market action. And so what this is telling me is the interesting thing is that these two occurrences are within our 23.5-year cycles. Okay. This one is the 1929 high, and this one is the high in 2000. They're right on line with those 23.5-year cycles. Now, this is a sub-cycle theoretically, but it's not in terms of the 94 years. So the only thing we have on this chart, basis the 94-year cycle, is this one right here, 1929. And so this fits in with that 94-year cycle almost perfectly. It's telling us that, hey, this is what's happening in terms of valuation. And you're also in that period of 94 years longer overall cycle, or breaking up into 23 and about 23 and a half years. Okay.
Which works from the 2000 to 2023, right?
Exactly. And again, as I said earlier, which 2000 top do you use? I mean, if you use the New York Stock Exchange, which is all the stocks on the New York Stock Exchange, that did not happen until early September of 2000. So if you go forward 23 years and let's say a 23 and a half, actually, when I figured it out, it came to 23 years and 7 months. And that's what takes me into January of 24. So we're right. I mean, if you zoom in, remember, we're talking about a 94-year or 23.5-year cycle here. You're not going to expect to hit it exactly because there are other sub-cycles working. But it's just telling us that both on a fundamental basis based on the Husman work, and again, you can go to his website. He explains everything that he does, and the 94-year cycle. This is where we are, folks, and it's a pretty scary outlook. Okay,
So
I've done
that's
about,
based on valuation. So he's saying that the valuations have gotten so excessive
yes.
that we
And
should
what,
expect them to retreat, and that, so
for the first
that.
time since, as I said, he's been talking about this blue line for a couple of years now. If you look at this, is 2019 right here. So
Right.
probably it got down to this level around 2021, 22.
Mm-hmm.
And now we're entering into 2024 and it does this. I mean, the expectation would be from here that, okay, this starts to go up and the market starts to come down. Well, no, thank you. That didn't happen. We not only did this, which took us down really close to prior extremes, in fact, lower than the 29 extreme, but it did this little twinkle to the upside and then this in even further excess to the downside. And so he said, just in the last couple of months, that this is now showing he considers the market now to be more overvalued than it was at the 1929 and 2000 peaks.
Mm-hmm.
And so this is the predicted return 12 years out. And that's pretty damn ugly, folks.